everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. Today, my guest is Sal Gilbertie, returning to the show, president of Teucrium Asset Management. Sal, great to have you back.
Great to be back.
The last time you were here, I might have been back in May or something, maybe before that. I know we had a down period in commodities, but that has really snapped back around, primarily due to the drought that we saw over the summer, in the grains, but also because of concerns or discussion about the central bank activity, so-called money printing. How do you see the environment now?
Well, the environment's a pretty healthy one for commodities, but that's no surprise to us. We focus on energy and ags, and those are the two things that people will always use. And with an expanding global population, we just think the demand for those things keeps rising, and therefore they're entering people's portfolios, they're entering people's investment horizons. But clearly, the drought affected ags very significantly this summer. You expected a record crop, especially in corn and soybeans. What you got was quite possibly the lowest crop in modern history will come out of those fields. And so that completely turned the markets around in a 4 to 6 week period, which is, I've never seen that happen before. I've seen it happen at tops, but not at bottoms like that, where a critical pollination time at corn, there was no rain. And that really focused attention on agricultural commodities. To your point about liquidity in the system, I think the initial reaction here has clearly been that commodities will rise, or at least be an asset class that's in favor due to the increased liquidity.
And your firm, Teucrium, you actually create instruments that allow investors to get exposure to commodities, various ETFs, etc. How much of that do you think is a factor in the commodity boom that we're seeing? I mean, in the past, historically, we have seen periods of commodity price increases, but then prices have always kind of come back down again. But this seems to be more of a secular advance. It is on a steady uptrend. And how much of that is due to just access to commodities for the first time through financial engineering, new financial instruments that people have available to them?
Well, that's a good question. I think it's a subject that's open to much debate. My personal belief is that the speculative flow, or the investment flow of funds that comes into the market, so long as it goes into these futures funds like Teucrium and other products that are futures based, where you're not actually taking physical off the market, I don't believe it contributes to a secular price rise, as you would say. Supply and demand is everything. That's what the end user is affected by most directly, supply and demand of the actual commodity. Remember that investors investing in, say, an exchange-traded product that's futures-based, they never actually take that commodity, not in energy or agricultural commodities. And so they don't directly affect the supply and demand. And in fact, prior to the drought, agricultural commodities were headed to multi-year lows. And so I don't necessarily believe that this inflow of capital is causing inflation at the consumer level.
Well, let's talk about that, because I've heard that argument before. But if you're a producer and you see this freight train of money flowing into a particular commodity that's bidding the price up, aren't you a little bit hesitant to put supply out there, or at least you're lifting your price? And if you're, producers in the aggregate, if they're price setters by virtue of their ability to bring supply to the market, aren't they actually, isn't the whole dynamic causing them to set prices higher and higher? You're not going to step in front of this, freight train of money. You're going to lift your prices.
I think an astute hedger in the forward curve will do that, meaning a producer who needs to forward sell some product. They're not actually selling their physical production, but they are financially hedging it by selling futures.
But isn't this a price-setting mechanism then?
Sure it is. Yes. Sure it is. But the thing is, it's a price-setting mechanism for a hedger and someone willing to take the other side of that hedge, either another hedger or an investor or speculator. When it comes down to actually using the actual product itself and delivery is made by that producer, the speculator isn't taking delivery of corn. They're not letting a truck of corn come and get dumped in their yard, bottom line. So I don't believe that in the end user actually pays more because of speculation in the forward curve or investment money in the forward curve. And if anything, when a producer sees prices rising, they produce more.
Corn. Let's talk about corn, because corn now used in ethanol production. Has corn become just another form of gasoline, basically? I mean, and if that's the case, is corn's trajectory up and up and up because of tight, gasoline supplies around the world?
Well, corn ethanol is a byproduct of corn. Corn, there's a lot more corn grown now than there ever was, primarily because of ethanol. But what people don't know is that ethanol is a component of gasoline. It's a necessary component. There are very few cars burning just ethanol, E85, 85% ethanol. And so really it's a necessary component to make our gasoline pool across the country work. The fact that we've switched from MTBE, a chemical that poisons groundwater, to a grain alcohol, which is ethanol, is actually good for the environment and better. The fact that farmers can respond and produce all this corn, ethanol has been significantly lower in price per gallon than gasoline. So in effect, ethanol is contributing to a lower price per gallon. In other words, if the ethanol blend is 10% and ethanol is 50 cents a gallon less than gasoline, that is saving the consumer 5 cents a gallon, and that's very substantial. One other point is that you take the starch out of the corn in order to turn it into a sugar in order to make ethanol, but what is still left is the fiber, the protein, the oil. That's actually animal feed. So we've actually increased the animal feed supply by the other byproduct of ethanol production called distillers grains, which wouldn't have existed without the ethanol market. I think that's why the food for fuel debate went away.
Now, as more acreage is devoted to corn, which we see happening, what does that mean for other crops?
Well, corn and soybeans fight for acres. So what will happen is the market mechanism will incent a farmer to plant either corn or soybeans, and it's always every year a very interesting battle to see what happens. South America is a great variable. They do plant corn down there, but they're more substantial soybean producers. You've got the U.S., Argentina, and Brazil as the world's top 3 soybean exporters, and so you've basically got a 6-month season for soybeans. So corn is really the big crop. It does compete with soybeans for acres, but corn's the big dog in the game.
And in terms of ethanol, and you mentioned South America, we've got to talk about Brazil, because they actually use sugar to produce their ethanol. So where does sugar play into all this?
Well, sugar, like now the grains, corn and soybeans, it's interconnected with the fuel markets. And so, the fact that they make ethanol from sugarcane means that sugar not only responds to the supply-demand picture for itself as a base commodity, cane or sugar, but also for energy, because ethanol is directly related generally to the price of gasoline. It fluctuates with energy prices. So
now, with the drought that we've seen and the impact it had on corn output, USDA lowering its crop forecast, what price levels are we going to be looking at?
Well, I think we're going to be looking at probably higher prices for corn than we've been accustomed to for the past many years. The past 3 years have seen 3 consecutive years of declining yield. So the markets are getting used to a slightly higher price for corn. We've probably got another growing season or 2 to go before we catch up with supplies and actually get corn prices stabilized in a range where they're more predictable than they are now.
Switch a little bit to oil markets. We've seen a very sharp snapback, as with other commodities, back almost to $100 recently, WTI. A lot of stuff out there, Middle East tensions, flare-ups everywhere, the attack on the U.S. Embassy in Libya. Where do you see oil prices headed?
Well, I think they're going to remain pretty stable from a geopolitical tension standpoint. I think you're exactly right. Remember, globally we use about 90 million barrels of oil a day. That's a big number. In the U.S., I think it's about 19 million barrels of oil a day. We use it day in and day out. And I think that one thing that the Saudis are very cognizant of is that if the price gets too high, that has a negative effect on the global economy. I think many people were counting on the price of oil. We'd seen it dip down there into the 80s on WTI, right, towards 100 on Brent, and many economists, especially that I was reading, were encouraged because that was a good economic stimulus. We've kind of lost that now with oil headed back up. We'll have to see what happens.
Good point. Some headwinds to the economy. Very quickly, like Any new funds coming out that we should look for?
We're quiet right now. We've got 7 funds. We're happy with what we have in the energy and agricultural space and 1 agricultural basket. So things are on the drawing board, but we're happy with what we have.
You must be happy. I know that because last time we spoke, things were a little bit more depressed, and they've come back. So it's good to hear.
Things have snapped back. We've been a beneficiary of some of the commodity inflows to our funds, and they're good funds, we think. So.
Fantastic. Sal, always great to talk to you. Thanks
Pleasure,
very much.
Mike. Thanks.
All right. That's it for now, folks. This is Mike Norman saying see you next time. Bye-bye.